Investing can be intimidating, especially for those who are risk-averse. The fear of losing money often prevents people from taking the first step toward building wealth through investments. While all investments come with some level of risk, there are strategies and asset classes that are lower risk and more suitable for cautious investors. If you're unsure about diving into the world of investing due to fear of risk, this video will explore the top 10 ways to start investing while minimizing your exposure to risk. 1. Start with a high-yield savings account. If you're completely new to investing and want to take a cautious approach, a high-yield savings account can be a great starting point. While savings accounts traditionally offer low returns, high-yield options provide higher interest rates than standard accounts, making them a safer way to start earning passive income. Why it works? A high-yield savings account is extremely low risk, and your money is typically insured by the FDIC, Federal Deposit Insurance Corporation, making it a safe place to park your money. While the returns won't outpace inflation significantly, it offers peace of mind and serves as a foundation for building a financial cushion. 2. Consider certificates of deposit, CDs. Certificates of deposit, CDs, are another low-risk investment option. When you invest in a CD, you agree to lock your money away for a set period, typically ranging from a few months to several years, in exchange for a guaranteed interest rate. Why it works? CDs are insured by the FDIC, so you won't lose your principal investment. They provide a fixed return over a set period, offering certainty and stability. However, the trade-off is that you cannot access your money without penalty until the CD matures. For investors who are risk-averse but want to earn more than a savings account offers, CDs are an excellent choice. 3. Invest in bonds. Bonds, particularly government bonds or highly rated corporate bonds, are considered relatively safe investments. When you buy a bond, you're lending money to an entity, such as a government or corporation, in exchange for periodic interest payments and the return of your principal when the bond matures. Why it works? Government bonds, such as U.S. Treasury bonds, are backed by the government and are among the safest investments available. While bonds generally provide lower returns than stocks, they offer more stability and lower risk. They are an excellent option for conservative investors looking for steady income with less volatility. 4. Invest in dividend-paying stocks. Stocks can be risky, but dividend-paying stocks are a more stable option. Dividend stocks belong to companies that regularly distribute a portion of their profits to shareholders. These companies are often well established and financially stable. Why it works? Dividend stocks offer a steady income stream through dividends, which can help mitigate the potential volatility of stock price fluctuations. Even if the stock price drops, the dividend payments provide investors with regular returns, making them a safer way to invest in equities. 5. Use dollar cost averaging, DCA. Dollar cost averaging is an investment strategy where you invest a fixed amount of money into an asset or portfolio at regular intervals, regardless of market conditions. This strategy helps you avoid trying to time the market, reducing the impact of short-term market fluctuations. Why it works? DCA allows you to spread out your investments over time, which helps reduce the risk of making a large investment at the wrong time. By investing consistently, you purchase more shares when prices are low and fewer shares when prices are high, effectively lowering the average cost per share in volatile markets. 6. Index funds and ETFs. Index funds and exchange-traded funds, ETFs, are diversified portfolios that track the performance of a specific market index, such as the S&P 500. These funds typically contain a wide range of stocks, bonds, or other assets, making them less volatile than investing in individual securities. Why it works? The diversification offered by index funds and ETFs significantly reduces risk. Since they hold a broad range of assets, the performance of any single stock or bond has less of an impact on the overall value of the fund. These funds are a great way to invest in the broader market while minimizing risk through diversification. 7. Real estate investment trusts, REITs. Investing in real estate can be a great way to build wealth, but directly buying property can be expensive and involves significant risk. Real estate investment trusts, REITs, allow you to invest in real estate without owning property directly. These companies own, operate, or finance real estate projects and pay dividends to shareholders. Why it works? REITs allow you to gain exposure to the real estate market without the responsibilities of property management. They are generally less risky than directly investing in property, and they provide regular income in the form of dividends. Additionally, they offer diversification, as many REITs invest in different types of properties across various sectors. 8. Invest in a robo-advisor. If you're new to investing and want a low-risk, hands-off approach, consider using a robo-advisor. Robo-advisors are automated investment platforms that create and manage a diversified portfolio of stocks, bonds, and other assets based on your risk tolerance and financial goals. Why it works? Robo-advisors provide a low-cost way to invest, as they typically charge lower fees than traditional financial advisors. They also take your risk tolerance into account, so you can start with a conservative portfolio that gradually shifts toward more risk as you become more comfortable with investing. It's a great option for those who are nervous about choosing investments on their own. 9. Peer-to-peer, P2P, lending. Peer-to-peer lending platforms allow you to lend money to individuals or small businesses in exchange for interest payments. While P2P lending carries some risk, it can be an attractive low-risk option if you diversify your investments across multiple borrowers. Why it works? By spreading your investments across different loans, you reduce the risk of losing money if one borrower defaults. Additionally, P2P lending can provide higher returns than traditional savings accounts or bonds. However, it's important to carefully research platforms and borrowers to ensure the loans are reputable and come from reliable sources. 10. Precious metals, gold and silver. Gold and silver are traditional hedges against inflation and economic uncertainty. These metals tend to hold their value over time and can act as a store of wealth during periods of financial instability. Why it works? Precious metals like gold and silver are tangible assets that generally retain value, making them a safe haven for risk-averse investors. While their prices can fluctuate, they have historically performed well during times of high inflation or economic uncertainty. They're a low-risk option for protecting your wealth in uncertain times. Investing doesn't have to be risky. By starting with lower-risk assets and strategies, you can gradually build confidence and experience as you grow your wealth. High-yield savings accounts, bonds, dividend stocks, and index funds are all excellent options for conservative investors. Additionally, strategies like dollar-cost averaging and using robo-advisors can help reduce risk and provide a more hands-off approach to investing. By taking small, consistent steps, you can begin investing with peace of mind, knowing that your investments are designed to minimize risk and build wealth over time.